The S&P 500 has lost around 10% of its value since early January. Is it time to get cover, or is there an opportunity brewing in the general stock market? I think an opportunity is coming up over the next several days. And I think there is a pretty good chance, although there are no 100% certainties, and I urge you to make your own analysis. I just share my views here, and I hope you find these videos interesting. I think there is a pretty good chance that we've seen a daily cycle low over here on the 24th of January, and given the decline, given the drop down into this Monday low, I think there is a pretty good chance that the intermediate cycle has also finished relatively early at only 112 days old. And that's also corroborated by the fact that the previous intermediate cycle was unusually long at 214 days old. And with the average duration of around half a year, a shorter cycle would actually bring things back closer to that average. Let's have a look at a few very interesting indicators in relation to the general stock market. But for more details, you are always welcome to join us at myfinancesteacher.org, where I post nearly daily updates on a range of markets. The first chart I want to show you is this split chart. On the left side, we see the optimism index for the general stock market, and it's pretty low right now. It's just bouncing from the level of 20. That's actually the lowest we've seen this optimism index at since that pandemic crash in March 2020. So the market sentiment is quite low right now, and as I keep repeating in many of my videos, the time to buy is when that proverbial blood is on the streets. And I think the streets are pretty sticky right now. But again, as I mentioned, for more details, you are more than welcome to join us at myfinancesteacher.org. Another very interesting indicator is the smart money and dumb money confidence levels. The blue line over here is smart money. Those are institutional traders, and those are the ones that you usually want to follow. As you see, whenever the blue line peaks over here, that's usually is around the time when the general stock market, the black line at the top, bottoms out. And as you see right now, the smart money is really confident that we are going to see some sort of a low relatively soon on the general stock market. And I do agree with that opinion. The red line over here is the dumb money. Those are retail traders, small traders. Those usually follow the herd. Whenever the market sentiment is down at the floor level, that's when the dumb money, the retail traders, the herd followers don't have any confidence at all in jumping into the general stock market. And that's basically where we are right now. One more interesting indicator talking about small retail investors is this American Association of Individual Investors, a bull ratio. That's the ratio of bulls to bears. We see that the bull ratio is pretty low, meaning that most of these individual investors are really bearish right now. This is actually a bit of a longer term view, as this indicator is weekly rather than a daily indicator. So we are looking back at over 3 years over here, and the indicator right now is as low as it was actually at the pandemic crash, and as low as it was in December 2019 decline in the stock market. It was not much of a crash, but it was relatively painful. So yeah, this also tells you that that street is pretty sticky right now, and perhaps it's time to get your positions in. Of course, nobody knows the future, and the stock market can still decline for a few days perhaps. After all, there is quite a lot of volatility on the stock market over the last few days. The S&P 500, for example, is ranging from all the way down at 42.26 all the way up to 44.50. A lot of volatility right now. So yeah, it is scary right now, and perhaps using stop losses, or at least partial stop losses, is a good idea. But I do think that some sort of an opportunity is brewing in the markets. A quick look at other markets. We're looking at Biotech right now. Back at the end of December last year, somewhere around here, I thought that the intermediate cycle on Biotech finished over here in early December, giving us a cycle lasting for 209 days. Yeah, I was clearly wrong. Biotech has dropped quite hard after that, partly because of just following the general stock markets down since early January, and partly for whoever knows what reasons. Biotech is actually quite volatile, and the intermediate cycles generally last for around a half a year. So similar to the cycles in the general stock market, and often biotech does actually follow the general stock markets in its cycles. I do have a position in biotech. Yes, it's down quite a lot, but I've mentioned to the members at myfinancesteacher.org that I was going to look at this position as a long-term position. In the longer term, I think biotech should do relatively well. I don't think the population anywhere in the world is getting any healthier, or even any younger for that matter. The aging population is a bit of an issue in most countries of the world. But yeah, biotech can be quite volatile, quite painful at times. But looking at earnings per share of at least the top 5 IBB constituents, it seems that biotech is oversold right now versus their trailing 12 months earnings per share. And I will share more details on that in the next few days with the members at myfinancesteacher.org. A quick look at precious metals. But before that, let's have a quick look at the US dollar. As I mentioned in my previous video, that's from 19th of January, I mentioned that there was a 60% chance that dollar is starting a new intermediate cycle rally, meaning that it's gonna give us perhaps a higher high. That's exactly what happened, with the other scenario being a 40% chance of a continued decline in the US dollar. So what that means for gold is that there was a 60% chance of gold dropping down versus gold continuing higher, and we do see gold down. But I think the pain is not going to last for very long. The daily cycle is right now 44 days old. Usually these cycles last anywhere between 1.5 to 2 months. So perhaps another week of some pain in gold. That's actually when the Asian markets are going to open up after the Chinese New Year. So that's likely to give us that intermediate cycle low in precious metals. Some of the support zones would be somewhere around 1760. That has been tested and respected a few times since late last year. But with the upcoming low probably being the intermediate cycle low, there's also a pretty good chance that 1760 is not going to hold. One thing to notice here, whatever happens to gold, actually most of my precious metals related positions are in silver rather than gold. So longer term, I really do love silver. The longer term market fundamentals for silver are pretty bullish. Lastly, let's have a look at a few more commodities. Let's have a look at grains, for example. Corn. I think corn is ready to top for its ongoing cycle. Usually, at least since mid-2016, these cycles last for an average of 148 days. The previous cycle was pretty short at only 96 days, so perhaps we're going to see a bit of a long cycle this time. So far, this cycle is 107 days old. Well, we do see some sort of a negative divergence over here versus the 14-day RSI, meaning that price is showing us higher high while RSI doesn't. We do see some pokes above the Bollinger Bands, although Bollinger Bands are not extremely wide, meaning that these pokes above the bands are not extremely important. So perhaps another few days of upward momentum. Some of the resistance zones would be from this June high, that's somewhere around 640. And that might turn out to be our cycle top, followed by a few weeks of a decline into perhaps somewhat of an average duration of the cycle, around 140, 150, 160 days long. And that's when I will try to get back into corn. Let's have a look at soybeans. Soybeans right now is 80 days into its cycle. The cycles last for 145 days on average since late 2015. Soybeans have actually been doing really well, and I think soybeans will be ready to top out within the ongoing cycle sometime over the next couple of weeks. So if you are a very agile trader, if you're a trend follower, perhaps you might try something in the short term over here. In my own trades, I try to go against the herd. I try to make contrarian trades, although sometimes I notice that following the trend might actually just be easier. So instead of jumping over here, I'll be looking forward for a bit of a buying opportunity sometime over the next couple of months, when I will see that soybeans are coming down into its cycle low. Looking at wheat, it's kind of interesting because I think the wheat cycle has started quite recently in early January, and we do have a position in wheat, and we've actually already taken part of the profit out of that position once wheat went above that 50-day moving average. As I've mentioned to the members at myfinanceteacher.org, perhaps this wheat cycle isn't going to be amazingly productive because wheat, after all, has already gained quite a lot over the last couple of years and hasn't seen as much of a consolidation as corn, for example. We see corn topped out in early 2021, same as soybeans, by the way. But wheat instead has been doing higher highs all this time, so perhaps a bit of a consolidation is likely. So we do have our stop losses in place just in case if this wheat cycle tops out a little bit early and decides to consolidate for a while. And lastly, let's have a look at coffee. Actually, I haven't looked at this chart for quite a while. I mentioned there was a chance of a cycle low over here in early January to the members quite a while ago, but I wasn't extremely certain about that as the decline into this cycle low was not that painful. But perhaps coffee is interesting over here. Let's see if it holds the 50-day moving average, and the cycle is less than a month old right now, and on average these cycles last for around 138 days. That's at least since late 2016. So in the very short term, perhaps coffee might be kind of interesting right now, but similar to wheat, it hasn't actually had much consolidation after gaining over 100% since the pandemic low. So I think perhaps a bit of a sideways move within this ongoing cycle is quite likely. Let's see if it holds 50-day moving average, and I might have to ponder about this chart for a while over the next couple of days. And while I go ponder about that, let me know in the comments below, do you think it's dangerous to jump into the general stock markets right now? Or do you think there is so much fear in the markets that it's actually a good idea to get at least some positions in? Share your opinion, share the video with your friends, subscribe to the channel, and have a nice Friday. Bye-bye.